Economic analysis of hypothetical Republican-led tax and spending bill. If a Republican-led Congress passes a major bill featuring tax cuts and spending reductions, similar to the 2017 TCJ or proposed GOP budgets, here's a breakdown of the likely economic effects. Short-term economic effects, 1 to 3 years. Pros: boost to corporate profits and stock market, lower corporate taxes and capital gains cuts could spur business investment and equity market gains. Consumer spending uptick, middle-class tax cuts, if included, may increase disposable income, supporting GDP growth. Business confidence, deregulation and tax incentives could encourage hiring and capital expenditures. Cons: higher deficits. If tax cuts aren't offset by spending cuts, the federal deficit could balloon, risking upward pressure on interest rates. Inflation risks. If demand outstrips supply, for example, via consumer spending, the Fed might delay or reverse rate cuts. Inequality concerns. Benefits skewed toward high earners and corporations could exacerbate wealth gaps. Long-term economic effects, 5 to 10 years. Pros: potential GDP growth. If tax cuts incentivize productivity gains, long-term growth could rise. Historical example: the 2017 TCJ contributed to a temporary GDP bump, 2.9% in 2018. Competitiveness: corporate rate cuts might attract foreign investment or deter offshore. Cons: debt sustainability. Persistent deficits could force future austerity, for example, entitlement cuts, or crowd out public investment. Underfunded public services, reduced social spending might strain education, healthcare, and infrastructure, hurting human capital. Interest rate pressures. Higher debt could lead to rising borrowing costs for mortgages, businesses, and government. Sector-specific impacts. Energy and manufacturing, likely winners from deregulation and subsidies. Tech and finance, benefit from capital gains cuts and repatriation incentives. Healthcare and education, potential losers if Medicaid or student aids cut. Key uncertainties. Fed response: will the central bank tolerate higher inflation to accommodate growth? Political durability: future Congresses could reverse cuts, for example, 2025 TQ expiration cliff. Global context: if other nations mimic tax cuts, the US competitive edge diminishes. Historical parallels. Trump's 2017 TCJ initially boosted growth but added $1 to $2 trillion to deficits. Corporate investment rose briefly, but gains were uneven. 1980s Reagan cuts, similar growth debt trade-offs. Debt/GDP rose from 26% to 41% by 1988. Bottom line: a bill might stimulate short-term activity but risks long-term fiscal instability unless paired with spending discipline. Distributional effects likely favors investors and high earners over wage workers. Structural reforms needed. Without productivity gains, for example, via infrastructure or R&D, tax cuts alone won't sustain growth.